If you're like most investors, you've probably been hit pretty hard here in 2022. As of mid-July, the S&P 500 index was down almost 19%, after gaining almost 27% and hitting all-time highs just the year before. The turnaround was sharp as investors started heading for the hills towards what they thought was safer ground. While some people may have had good reason to jump out these past 2 quarters, it's likely that a large number of investors did it simply out of fear. What have we seen? The tech-heavy NASDAQ down around 27%. Dow Jones down about 14%. The Russell 2000 down 22%. With such big drops in just 6 months, there's a human instinct to try to do something about it. The problem is that doing something almost never works out. If you look throughout history, you'll see the worst days in the market were often followed by some of the best days in the market. And when fearful investors bail out after a drop, by doing so, they wind up missing out on any potential recovery. Remember the end of 2018 when the S&P fell more than 9%? People who jumped ship missed out on the 8% total return gain that happened in the S&P just 1 month later. The result, as a Dalbar study showed, is the average investor winds up lowering their overall returns significantly. So with that information in mind, it's a good idea to take notice of a few things. First, corrections in the market happen almost every year. In 21 of the last 41 calendar years, that's more than half of the time, the S&P saw a double-digit pullback within the year. In every year since 1980, there's been a market pullback, and on average, the market experienced a 13% decline. In the years when the S&P did experience a double-digit decline, 13 of those 21 times, that's 62% of the time, the market ended the year with a positive return. Second, you should know that it's pretty rare for the broad market to post negative returns for 2 straight years. It really only happened 3 times, once in the 1970s, once in the early 2000s, and way back in the Great Depression. That's no guarantee it won't happen this time, but it's important to keep those stats in mind. The third thing to remember is that stocks have historically gone up more than they've gone down. Since 1926, equities have posted positive returns over a 10-year period, 94.6% of the time, and over any 15-year period, 99.8% of the time. And stocks over long periods of time have far outperformed money markets or government bonds. A $1,000 investment in T-bills in 1926 is worth around $20,000 today. That same investment in U.S. small company stocks is now worth more than $5 million. The point here is that the more you resist your first impulse to sell in a panic, the better off you potentially are once the market recovers. This is why we have a bucket strategy. Knowing that the equity bucket won't be needed for 10 or more years often gives people the assurance they need to keep calm and simply enjoy their retirement. Because, believe it or not, sometimes the best thing you can do is nothing at all.